Morning, everybody. Welcome to the September edition of our Economic and Investment Update. For those of you who are new to our webinar, my name is David Baker. I'm the Chief Investment Officer and Partner here at Mazars, and I'm joined, as usual, by our Chief Economist, George Ligarias, who is normally in warmer climes in Athens, but I'm pleased to say he's here with us today in London. So what to say by way of introduction? If you do have a question that you'd like to pose to myself and George, we will try and pick those up at the end. So please do feel free to put those in the Q&A tab as opposed to the chat tab. And we'll talk for about 30-35 minutes and then hopefully leave around 10 minutes at the end to pick up any of those questions. So without further ado, what's been going on in the world? Well, I think we said at the start of this year, having had a very disappointing year for investors in 2022, we said that bad years tend not to be followed by another bad year, and that wasn't a prediction. It wasn't a sort of comment on global economics and how that translates into markets. It was really just an observation of how things tend to have patterned in the past. And as you can see, that's played out to an extent, by which I mean equity markets have been an awful lot stronger this year, albeit bond markets in the middle of this chart, US Treasuries and gilts, still haven't given a return. And in fact, you've had a slight negative from that. But nonetheless, equity markets have somewhat recovered following their sell-off last year. Far left-hand side, you can see that the best performing market, at least in local currency terms, was Japan. It's typical when Japanese equities do well that the yen is falling against other currencies. So you can see quite a big differential between what a yen investor gets at around 30% and what a sterling investor gets at just shy of 13. But why has Japan done so well? Well, there's some corporate reforms going on that we've spoken about before, but also, probably most significantly, it's a reflection of where they are in terms of monetary policy. So you haven't seen significant inflation in Japan relative to what we've seen in the Western world, albeit by Japanese standards. It's really quite high because, as you may well know, Japanese inflation has been pretty much non-existent for decades. But their central bank seems to be quite relaxed about that, and they've said they want to see inflation above target for at least 12 months. And we've seen 7 months of inflation above target so far, so maybe a little bit further to go before they actually put interest rates up. So not the same headwind for equities in Japan as we have elsewhere. And so some quite dramatic returns in Japanese equities, despite the fact that one of their big trading partners is China, and China is arguably struggling a little. So great news story in Japan. The US is second in sort of local currency terms, but actually the front runner in terms of sterling investor terms. And as we've spoken about before, you've had a lot of enthusiasm, which ebbs and flows, but nonetheless, over the year, a lot of enthusiasm for tech stocks, in particular those that have some sort of connection to the evolution around artificial intelligence. The UK languishing at just sub 6%, tends not to have a lot of those exciting growth stories around technology. And you may well have read that ARM, which was previously privately owned and then owned by SoftBank, has listed not all of its equity, but some of its equity, and it's chosen to list in the US because that tends to be the place to go if you are a tech firm. So equities doing okay year to date. We've talked about currencies. Sterling has been reasonably strong throughout the year against both the euro and against the US dollar, but you've probably seen that come off quite a bit in recent weeks, where we were at levels of sort of 130 against the dollar. That's now back down to about 122. But the big bar there on the right hand side in terms of currencies is the yen depreciation against the US dollar and indeed everything else. Probably the last thing to pull out on this slide is that we are seeing the price of oil going back up again, and you'll recall that this was a significant part of the inflation story. And albeit the oil price and energy costs aren't counted in core inflation. When we calculate inflation and refer to core inflation, that's excluding the costs of food and energy, simply because they're extremely volatile and they tend to give peculiar month-on-month data points. So albeit it's excluded from that core inflation number, which is what central bankers look at when they're thinking about inflation and monetary policy, inevitably those higher prices feed through to other goods and services. So that rise in the oil price, we think, will have upward inflationary pressures moving forward. So, it's not all rosy in the economy, but nonetheless a much better start to this year. And of course, we're now in September, so we're into the business end of the year than we had last year. So I mentioned bonds haven't given a particularly good return, in fact, slightly negative, but there is, as the title slide suggests, a promise of returns. So by which I mean we've got much higher yields. The light blue line at the bottom there is broadly corporate bonds, so lending to companies who are deemed by the market and by credit rating agencies to be somewhat creditworthy, and that's paying you about 4% on a global basis. And the dark blue line being the high yield, what we used to refer to as junk bonds, smaller companies less creditworthy, and they are paying in excess of 9%. So a reasonably attractive yield if you're at that part of the market. Now, when you're looking at that, obviously you've got to factor in what is the economic environment and are any of these companies likely to default on their debt. The reason that you get paid so much on high yield is a reflection of where interest rates are generally as set by central banks, but also the compensation that you expect by taking that risk by lending to a company with less well-established cash flow, etc., etc. So this is not without risk. We haven't really seen a significant uptick in the default rates on corporate debt, but there is an implication of higher interest rates when these companies need to refinance their debt, how easy that's going to be, and whether there's going to be some restructuring or indeed some insolvencies off the back of that. So on the face of it, if we look at this short time period, it suggests that yields are pretty high. You've got the big spike associated with COVID at the start of 2020, but ignoring that, yields have definitely gone up and could prove to be attractive. However, if we move on and look at a sort of longer term time series, and this going back to 1990, we oughtn't to forget that we have been in an extremely peculiar phase after the global financial crisis up until COVID and the inflation that ensued after that. So we shouldn't ignore the fact that the rates that we're seeing now and the yields that we are seeing now are not particularly unusual if you ignore this period that's shown there in white as quantitative easing and the pandemic, characterized by very loose monetary policy, both in terms of ultra low interest rates and quantitative easing pumping money into the economy. And we've spoken a lot over the last couple of years about the move from quantitative easing to quantitative tightening, where central banks taking the money back out of the market, and that being a significant element in terms of financial conditions. So actually, if we compress that chart and just remove the quantitative easing and pandemic period, which I'm hoping is going to happen magically before our eyes. There we go, thank you. You can see that we're still probably somewhat below what we've termed there as being comparable periods. So, periods where monetary policy was much more normalized if you look at it with a long-term view. So financial conditions are tight or tighter than they've been over the last decade, certainly, but there's probably still space for them to go a little bit further than that. So Where are we in terms of monetary policy? That this has been the conversation. We said at the start of the year that it would be the conversation throughout the year, and indeed that has been the case. You will have seen that last week the Bank of England chose not to raise rates, and indeed the US Federal Reserve did exactly the same. ECB put rates up one more time, but were pretty clear that they expected them to stay at that level from henceforth. And that is really where markets are at now. They're starting to believe central bank and their narrative and their rhetoric, and have moved away from this assumption that interest rates are going to be rising for a period of time, but then they're going to come down quite quickly. And the theory says you put interest rates up, that makes financial conditions worse, slows the economy, brings inflation down, and that then sort of pushes you into the need to then cut rates to support the economy into a new phase. But the central banks have never really committed to doing anything of that ilk. And what they've actually been quite consistent about, and now a little bit more explicit about, is that rates are going to be higher for longer. And by higher, we don't necessarily expect them to go much higher than they are now, albeit the UK and the US might put rates up 1 or 2 times more. But more important is the period of time that they're going to stay at the current level, what we would expect to be a normal level. And I think central banks have pined for this situation where they could do this, having gone through that very odd period of very low rates and quantitative easing. The question has always been, how do we actually get back to something that looks like normal, sensible interest rates and monetary policy? So higher doesn't necessarily mean higher than we are now. It's higher than we've experienced in recent times. The big question is, what does longer mean? Are we talking about 6 months, 12 months, 18 months, longer relative to what? And really what we mean is longer relative to market expectations. So a couple of months ago, markets were talking about rate cuts possibly starting in the spring, and they were looking at 5 rate cuts. Now they're looking at about 3 cuts, possibly starting later in the year, July, August time. And this has been the pattern of how markets have interacted with central banks over the last couple of years. Markets have always been a little bit more optimistic and a little bit ahead of central banks in terms of thinking what's going to happen to interest rates, and consistently having to recalibrate those expectations and shift them back 3 months, 6 months, and so on and so forth. So that's the environment that we're in. And central banks are very clear that they are going to be data driven, which is sort of Fed speak for, we don't really know what's going to happen to the economy. We know there's been resilience in the economy, and certainly that's the case in the US. But you could get the effect of interest rate rises coming through into the economy and showing up in things like unemployment and corporate health. You could see that coming through, and therefore the economy could take a downturn. But for now, things are reasonably stable. So just developing that a little bit further, this chart is probably a week or two out of date, so it indicates that maybe the first cut in May, and this is how quickly markets can move. That's now priced in at around July of next year. We are a little bit more cautious. We suspect that the economy is going to be resilient, and we suspect that if it is, then central banks will be quite comfortable if they feel they can get away with rates being where they are now. They would like to keep them there for as long as they're able. So economy is reasonably strong. There are, of course, always things to worry about. I mean, the US, you're starting to see that the savings that households have built up through COVID, where you weren't able to go out and spend, and indeed you were being given money directly from the government, those savings are being, if not completely depleted, then mostly depleted. You've got things like student loan repayments, which have been suspended for a period of 2 years. They have come back in. And you're starting to see a little bit of loosening in the jobs market, where the numbers of hours worked is falling, the participation rate is going up, so people who'd left the jobs market coming back into it. And indeed, you're starting to see elements of industrial action. So the three main auto manufacturing firms in the US, their workforce currently on strike, and some similarities to what we're seeing here in the UK. So there are economic reasons to think that maybe the market is right and maybe we will get a slowdown which will force the Fed to cut rates. And then of course you've got the possibility of some sort of financial accident. We saw it with Silicon Valley Bank last year. These things are always easy to discuss and be wise about after the event. The truth be told, they're very difficult to actually foresee coming. That having been said, the Bank of International Settlements, which is sort of the bank for central bankers, is starting to look at particular issues, technical issues about how hedge funds operate in the treasury market. So everybody's a little bit aware that there is the possibility of financial accidents driven by primarily the rise in interest rates. But as we stand at the moment, that's expectation. Somewhere in the summer is what the market is pricing in rate cuts to be. Okay, let's move on and just have a little look at the UK. Similar sort of thing. There's probably more space in the UK to cut rates than to raise rates than there is in the US. If you've seen the news commentary around last week's Bank of England Monetary Policy Committee meeting, you'll have seen that it was a pretty split vote to get to no raise. It was 4 on one side, 4 on the other, with the chair Andrew Bailey having the casting vote. So, normally we're used to seeing votes which are, 8-1, 7-2, and this is the first that we've seen 5-4 in quite some time. So again, just this reflection that you're probably somewhere around the tipping point where central bankers are thinking very carefully about, is this a point at which we have done enough? And that's always a very difficult conversation, because you do have these long and variable lags between interest rates going up and it actually having a real effect in the real economy, in households and companies. But you tend to get the feeling now that we're probably at that cusp where we're at, if not the peak, then very close to the peak of interest rates in the UK. So final slide from me, just to pick back up on the economy generally, and probably an important slide in terms of forecasts for corporate profits. And what you can see here is the last 3 years of earnings expectations. Ignore the big hike again, which was around the pandemic, or actually coming out of the pandemic, where a lot of companies saw earnings go up significantly. And you can see that there's not a huge amount of optimism for earnings growth over the next 12 months, which in some senses is a positive, because it leaves space for us to be surprised on the upside there. But having said that, that's probably not our central thesis. If we expect growth in the UK and in Europe and the US, we're not expecting very significant economic growth. China is probably a completely different story. They've suffered quite a significant slowdown, albeit their economic indicators have just started to bottom out and start to pick up. And it's obvious that they are, well into this transition period away from sort of low value manufacturing towards the manufacturing of goods at much higher value, things like electronic goods, and in particular electronic vehicles, which is obviously a huge growth area. So that's where we are. Very definitely that period of ultra loose monetary policy behind us. We're into a new phase, and we're we expect that we're towards the end of the first element of that phase, which is interest rates going up. Obviously, that all depends upon the path of inflation, but we think we're at a cusp in terms of monetary policy. So with that, let me pass to George, who'll talk us through a little bit more of what's happening in the world.
Thank you, David. Okay, so let's pick it up where David left it, and let's talk a little bit about the economy. Now, the global economy is slowing down. What happened in essence was that the economy was due to slow down earlier in the year, and then China suddenly opened its doors. Okay, and they did this very quickly in a non-organized way, which means that all the forecasts which said, oh, we're going to have a recession in the first half of the year, sort of moved now towards the second half of the year and maybe early in 2024. But as we can see in this slide, which is a model we have here at Mazars, it looks roughly at 87 macroeconomic variables from across the world. And you know, there is no need to be too technical about it. It shows the economic activity, and if it's below the line, it means that it's sort of below the average. So we can see where it is and where it's headed. So what we had predicted for early 2023 is happening now, mid to late 2023. Again, this is because of China. Now, the big element in this is inflation. Next slide, please. The problem with inflation is that much like the 1970s, there's not much we know about it. Inflation differs, you know, with every age, inflation differs. We're talking about a different kind of consumer, different geopolitical conditions, and so on and so forth. In the 1970s, it was all about the Arab states and turning off the oil taps. Now it's more about Russia and China's break with the Western world. And it was about COVID upsetting global pandemic, you know, the first global lockdown in history, upsetting global supply chains, which they may have come back, but now they still need to restructure to fit an India-based model rather than a China-based model. So whereas inflation is coming down, you know, from that extreme thing we saw, the 10% plus over the past year, it's still a way above the 2% tolerance level set by central banks. And B, if you look at the right-hand chart, the core inflation element insists. So the core inflation is inflation without energy prices. And the point here is that you know, we're talking about different economies versus the 70s, different openness in economies, different transmission mechanisms in interest rates, different consumers. So the answer is, when the Fed says it's data-driven, as David very well put it, data-driven means I don't know. It says data-driven, it doesn't say model-driven. We do not have a model. Nobody has a model of the world where they can take what is happening and sort of put it there and figure out what happens next. When it comes to forward-looking inflation, there is a lot of uncertainty. Okay, and that has some very important, not just macroeconomic implications, but portfolio implications. People might like the yield in bonds, but the yield makes more sense if you have an element, some sort of certainty about where inflation is going. Okay, if you do not know, then maybe you need to think of more complex solutions, right? But anyway, let's not digress. The next slide, please. It shows about one of the reasons that the global economy is slowing down, and that is trade wars. They're invisible wars, but they are happening. And the policy started by the United States in 2027 has continued under the second administration, and the war with China is intensified. So that tends to be further adding to inflation and further slowing growth down. Next slide, please. Now, in the 1970s, if we learned anything, was people might have seen the pictures of the of the crowds waiting outside the gas stations to fill in their tanks. They're very well known pictures in economic history. So what happened was that the Arab states closed off the tap in 1973, and they reopened it fine, but because geopolitics were still very much in flux, there was the Iranian Revolution in 1979, and then that caused another massive oil peak, and so on and so forth. And this is what you get when you have a world that is unbalanced. Okay, a world where things don't operate very well and not in a coordinated fashion. So now what we have is all picking up again. Above 90. On the one hand, you have Russia and Saudi Arabia testing the limits. Why? Because they can. Because in the past few years, American shale producers added to production. And they could also, help regulate prices and push them down. But now, as they have reached the limits of their own production, the marginal producer, which is Saudi Arabia, once again, they get to test the oil prices. Now, Russia obviously wants higher oil prices for reasons that are well understood. Saudi Arabia wants to test the limit of it. On the other hand, we have a potential deal between America, Saudi Arabia, and Israel about the future of the Middle East, which would probably lead to some de-escalation of oil prices going forward. So it's geopolitics is the point. It's backroom deals, it's major important decisions that are made by global leaders and all that. And oil is a geopolitical strategic commodity. It is unpredictable. And in this stage where inflation is overall unpredictable, oil unpredictability adds significantly to this picture. So again, the point is we do not know where inflation and thus yields are going to land. This is a very big takeaway from this from this session. Next slide, please. Now, one of the debates that we have had was, okay, fine, it's all about oil, it's all about supply chains, and yes, we could start a new cycle of inflation, what have you. But really what surprised people was that consumers were so resilient. Well, in the US, we know why that happened. Mr. Trump wrote a lot of checks and he sent them to households. And they were not really spending that money. So after the world reopened, they started spending it more and more. Now, our economists in-house, they figure that Americans are running out of excess savings at some point between now and maybe the end of the year. And we also see higher credit card delinquency rates, again, in the US. So people who relied on the credit cards, especially younger people, are now starting to fall behind on their payments. So we are seeing elements that the consumer, which was the resilient part of inflation, is sort of having less power. So here's how I think it goes down, and it's not evident because all we see is the headline numbers. We had the big inflation peak; it's sort of coming down. There is the core sticky inflation, that's because of the consumer. All other things being equal, this should come down too. But then comes oil, which can throw a spanner in the works and restart a whole possibly inflation cycle. It does go back to the simple "we do not know" argument, because you have no idea how these dominoes are all going to land. But what we're also seeing is that consumers are less willing to pay higher prices. So we just have to wait to see, between supply chain pressures and the company's willingness to put up prices to maintain their margins on the one hand, and consumers who just don't want to pay the high prices on the other. We'll see where the dominoes fall, which side of this equation. Next slide, please. So this comes directly from our investment team, and this is also sort of something we need to talk about. When all is said and done, even when we have the inflation issue out of the way, we're still thinking and trying to figure out, okay, fine, but what does the world look like then? On the one hand, you have two competing theories. On the one hand, that inflation volatility will persist and higher debts will eventually cause higher yields in developed markets as investors would trust them less. So this says essentially that, okay, when Greece, take my example, is fiscally profligate, the markets would punish it with higher yields. But that's not what happens, for example, with the United States, the United Kingdom, and other premium economies, where higher debt is quickly absorbed. So there is a theory that this will change because now debt levels are very high. And there is the other theory, which says that, you know what, it doesn't matter. People need to buy bonds somewhere. They need something to trust. And this will mean that developed markets will still enjoy that premium over emerging markets. And again, these are competing forces. So one more reason why we'd not know how yields might play out in over the longer term. You know, somebody buys a yield now for 4 and 5%. If they're expecting to get that yield back, that's great. You know, that's what they will be paid in the future, in the next 2 to 5 years, however big the bond is. But if they expect to be paid on top of it with capital appreciation as yields fall, that is a different question altogether, because that's where the uncertainty lies. Next slide, please. Now, as the world is unbalanced, it stands to reason that risks which were not managed but sort of kept under control are now becoming more pronounced. So the key risks we're looking at is obviously sticky inflation. We talked about the geopolitics. Central bank policy errors are very important, because you have no idea in this environment. Sometimes whatever the central banks do might be an error. They hike, might be an error because they tighten the economy. They don't hike, but they keep rates for longer, same type of error. If they reduce rates too fast and inflation picks up again, same error. Because no one has, you know, a decent set of information to act upon, the error is a possibility, and we don't call it an error until we look back and say, well, that was a mistake. Obviously, the possibility of a global recession is worrying us, as much as the Chinese economy leading that slowdown. Although, as David said, the data has been picking up lately. And these are the sort of things we're focusing on, along with other risks, of course, as you can see on there. Next slide, please. Now, this thing is not just for the stock markets. Any of you might have businesses or be working in a business that could be an M&A target, or any of that. M&A deals, which means mergers and acquisitions, essentially, are coming down very fast. This is a very bad year. It's actually a key indicator of how slow the economic growth has been. There are plenty of reasons for that, which go well beyond the few minutes I have left. But the point is that even in the private markets, in the real markets, where not the stock markets, which are influenced by derivatives and all that, we're seeing a massive slowdown. Next slide, please. Having said that, that activity might not remain muted forever, because there is a lot of what is known as dry powder. So there's a lot of money sitting on the side, waiting to see where they will invest. Right now, everybody is divesting, but that money is sitting on the sidelines and could go in at lower valuations. So this is another key takeaway here. The economy looks bad. Okay, no, the stock market looks much better than the economy, to be sure. So, you know, in terms of portfolios, things look way better, but the economy obviously is taking a turn for the worse. Having said that, there are plenty of investors waiting in the sidelines to buy at lower valuations. So I know it might sound a lot of gloom and doom. Oh my God, things are slowing down fast. But with all that money waiting in the sidelines, this is an effective cushion. Okay, that should eventually help things pick up going forward. Next slide, please. Again, this goes back to how the private equity outperformed stock markets over time and how this has reversed recently. And why are we talking about private equity in those markets? Well, in 2009, the powers that be stopped banks from giving money to Main Street, leveraging their deposits and give money to Main Street. And they said, okay, we have to regulate you now. You can't be doing that anymore, but still somebody has to do that job. So they gave it to private equities, okay, to private investors. If a private investor defaults, it's not the systemic risk because they do not have deposits. So what risks were with banks? We don't hear much about banks these days. What risks were with banks now are with the private equities. So there is a lot of dry powder to help them out, but we do identify this as the next big source of risk. And I think that's something we might be discussing in the next few quarters. Next slide, please. Now let's turn a little bit to the UK. Growth obviously has been sluggish. Really, year-on-year growth is near zero for the past 3 quarters. We don't call it a recession unless it's negative, but it is very much near zero. So the UK isn't growing, and that's because it's facing higher inflation, which is bringing than other countries, which is bringing real growth down. Next slide, please. And in this environment, and this is a key chart, insolvencies are rising. So in terms of outright insolvencies, we're seeing the highest rate of insolvencies since 2010. And this is a trend that we look at in the UK economy, and obviously it's disturbing. Now, a lot of the companies should have gone out of work during the pandemic. They kept receiving the checks, but now that these checks are done, some of these companies are also closing shop. So we just need to wait and see a little bit and see if the trend continues and where it stops. But it is obviously something we're looking at in the economy. And earlier David had the conversation, well, why did the Bank of England stop hiking rates? Well, charts like that definitely help, because if you look out of the window and you see what's happening in the real economy, maybe you figure out that the interest rate is high enough and you don't want to risk an acceleration of that trend, which has, as you all understand, it has significant economic and social implications. Next slide, please. Now let's look at the sort of industries in the UK that suffer the most: construction, wholesale and retail trade. By the way, a lot of it is Main Street shops that were already losing market share to online. So this thing just accelerated. And there is, of course, the hotels, the restaurants, all that. Companies, again, that were their particular business models changed, or think about the city. There is this big push for going back to the office. But so far that hasn't happened massively. And the restaurants here, they might have fewer people to work with, and if their margins were thin already, well, a few of them have to close down. And construction hurts because costs are higher, and as we said, retail hurts because online is extremely competitive. So all these are general trends. They don't have to do just with interest rates, but the higher interest rates tend to exacerbate the problem. In terms of economic performance, the UK is slightly running behind the US and and obviously China. It's at par with Europe, however, because Europe is slowing down because of its own reasons as well. And with that, I think we can open it up to questions. I don't think we need any more slides. We could open it up to questions.
Thank you very much indeed, George. So let's try and combine a couple of questions that are on a similar theme. So there was a specific question, George, about can the government afford the pension triple lock, and when possibly will it be scrapped? And then in a similar vein, governments keep giving out supporting handouts, and is this contradictory to tightening monetary policy? I mean, this is something we talk about, isn't it? Not just in the UK, but in the US. Fiscal policy is still pretty loose, and it's loose within economies that are heavily indebted, and we can only see that situation getting worse.
Yes, so the straight answer is that with the amount of debt burden that they have, which became worse after the pandemic, at some point, those governments are at risk. The more handouts, the bigger deficits, they are at risk. However, and of course, there is an element of personal experience here. Um, the United Kingdom is not Greece. Okay, markets will not punish it the same way as they would other emerging markets. So there is the question of perception here. The more the more markets trust the debt of those governments, the more governments can be open to those to those fiscal easing measures. But if markets turn on governments, then governments can't do anything. Remember the mini budget about a year ago? This was a lack of the loss of market trust, and you saw the repercussions of that, not just on the government immediately, but also on fiscal policy going forward. So, David, I would say this depends on markets. If markets have faith for policies, then you can be fiscally loose. If not, then you have to tighten very quickly.
Thank you, George. I mean, it's true that markets tend to be patient with those very well-established developed economies who have that status as being good borrowers, but that patience is not unlimited. Let's move on. Talk about politics a little and how that interacts with interest rate policy. There is the possibility of a general election in the UK in May of next year. It's sort of quite apparent with how Keir Starmer is positioning himself and Rishi Sunak's speech last week that they're sort of starting to get into electioneering mode. So the question is, given the increasing probability of a general election being called, do you believe this will be allowed to happen, or will extreme political pressure be exerted on the Bank of England to avoid or delay a technical recession? Now, the Bank of England is independent, but it's true, is it not, George, that to an extent that independence is interpreted by them as to when you're in election mode, you try and do as little as possible?
Well, independent is one thing. First of all, okay, let's be honest. The Treasury and the Bank of England are always on speaking terms, and also it is because they have to, right? If the one side decides to be loose with its fiscal policy, then it's up to the Bank of England to know this and make sure that the interest rate is appropriate, and vice versa. But I think that you're right, because ultimately this is an era where the media can they can exert a lot of pressure, and on occasion they can even be aggressive. So when somebody is sitting on the fence, that doesn't necessarily mean that they will be seen as independent or neutral. And that is the case with the central bank, David. If it does nothing, it's seen as helping the government. If it does something, it might be seen as undermining the government. If it lowers interest rates, it might be seen as helping the government again. If it was me, if I were Andrew Bailey, I'd just shut my ears and focus on monetary policy, because ultimately, how the central bank is seen is outside of its control.
True enough. Thank you, George. Let's try and squeeze one last question in, or two again mashed together. Is a recession coming in the US? And if so, what's your stance on equities for the next 2 or 3 quarters? And then just linking that in, whilst we're on the US, what are your views on the likely impact of the forthcoming US election? It's fair to say, George, is that we've been speaking about this as a team extensively in advance of our investment committee meeting on Friday of this week. And it's very, very difficult to assign a significant probability to any of the scenarios that are under discussion.
Yes, the visibility is zero. And the US election, it's a year away. If it were a normal election, maybe I'd venture a guess. Although this time in 2015, This time in 2015, yes, correctly. I would have never guessed Trump would have ever got elected. Okay. And remember, but David was a big surprise even on the day that he was elected. And then I would not have guessed that following that we would have seen a 33% rise in the stock market until he left. Okay, so not only is the outcome of those things extremely, volatile and unknown, but the second order effects are also unknown. Okay, so one thing that we need to be cognizant is what is within our power to know and control as portfolio managers, and what is outside of it. Like we always discuss, we're not here to sell certainty in an uncertain world. That's the job of soothsayers. We're here to manage uncertainty in an uncertain world. We see that there's a lot of uncertainty around, so our jobs as fiduciary duties is to manage that.
Absolutely right. Thank you very much indeed, George. We better leave it there because we are slightly over time. Thank you very much indeed for choosing to spend your time with us this morning. We do appreciate it. Apologies if we didn't get to any questions. There were quite a lot. But thank you very much for joining us. We hope to see you again later in the autumn. Goodbye.